The government put a timer on your retirement account in December 2017. Not a metaphorical timer, an actual statutory expiration date written into federal law, set to detonate on January 1st, 2026. And here's the part nobody led with. The people getting hit hardest aren't the wealthy who can hire armies of tax lawyers. It's the people who did everything right, the ones who maxed their 401k for 30 years, saved diligently, followed the advice, and are now walking into a trap that was architecturally designed into the system from the beginning, hiding in plain sight inside a bill most people forgot about the moment the news cycle moved on. I'm going to show you exactly how this works, why it compounds in ways that most retirement calculators completely miss, who it hits the hardest, and the 3 specific moves that can still reduce the damage because there is still a window. It's not wide, but it's open. And unlike most financial advice you'll hear this year, what I'm about to show you is built on actual IRS tables, actual tax code provisions, and actual math. No, trust me, bro. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Here is the central thing you need to understand before anything else. The government has always been a silent partner in your retirement account. You knew this when you signed up. You got the tax break up front, you contributed pre-tax dollars, they let it compound without annual taxation, and the deal was always that you pay on the way out. What you didn't fully internalize, and honestly, what most financial advisors didn't explain clearly enough, is that the government gets to set the terms of the exit, the rate, the timing, the size of the withdrawal, all of it. And in 2026, your silent partner unilaterally renegotiated. Think of it this way. You and a partner open a restaurant together back in your 30s. He lets you run it for 3 decades, keeps his name off the sign, never shows up for a shift. But he owns a percentage of every dollar you make when you eventually cash out. And here's the part that's buried in the fine print. He gets to decide on the day of the sale what that percentage actually is. You didn't read that clause carefully enough when you signed. Almost nobody did. I'm calling this the silent partner problem. And I'm going to return to the silent partner every time we uncover a new layer of this situation, because it shows up in 3 or 4 distinct forms that most people never realize are connected to each other. In a few minutes, I'm going to show you something called the tax torpedo, a combination of forces that can hit a retired couple so hard and so fast that their effective tax rate on a single year's income can spike by 15 percentage points or more. But first, let me walk you through what actually happened on January 1st, 2026, because most financial media covered it like a routine weather update when it was actually more like a scheduled flood that you had 30 days to prepare for. And most people didn't. The Tax Cuts and Jobs Act was signed into law on December 22nd, 2017. It lowered individual income tax rates across nearly every bracket. It almost doubled the standard deduction. It capped state and local tax deductions. It eliminated personal exemptions. And here's the part that got buried under the partisan noise on both sides. Almost all of the provisions affecting individuals were set to expire after 2025. The corporate tax cuts were made permanent. The individual cuts were not. That was not an oversight. That was a deliberate legislative choice made to fit the bill inside budget reconciliation rules, and it meant that the entire structure was always on a timer. Now, in 2026, the timer went off. What that means in plain numbers: the 12% bracket reverts to 15%. The 22% bracket goes back to 25%. The 24% bracket returns to 28%. The top rate climbs from 37% back to 39.6%. And the standard deduction, the number that reduced the taxable income of tens of millions of Americans, drops by roughly half. For a married couple filing jointly, you're looking at going from around $30,000 in standard deduction to somewhere in the range of $15,000 to $16,000, adjusted for inflation from the 2017 baseline. Personal exemptions return, which partially offsets that, but not entirely. The net effect is that more of your income is taxable at higher rates. Now here is where the typical person stops and says, I'm retired. My income is lower now than when I was working. I'm in a lower bracket. This doesn't really affect me. And they're not entirely wrong. But they're missing the silent partner's second move. And the second move is the one that actually costs you the money. There's a man, I'll call him Gary. And I want you to keep Gary in mind for the rest of this video, because Gary's story is going to get more uncomfortable in distinct stages, like a slow motion car accident where you can see each impact coming and can't look away. Gary is 67 years old. He retired at 65 from a career in manufacturing management that paid him around $110,000 a year. He maxed his 401k for 28 consecutive years. He rolled it into a traditional IRA when he retired. He has approximately $1.4 million in that account right now. He's been living comfortably off Social Security, a small pension from his old company, and occasional draws from a taxable brokerage account he kept separate. He thinks he's fine. He actually believes he has this figured out, and he did for a while. Gary's problem doesn't arrive at 67. It doesn't even arrive at 70. It arrives at 73, like a bill that was always in the mail. At 73, Gary is legally required to start taking required minimum distributions from his IRA. Not optional, not suggested, mandated by federal law. If he doesn't take the distribution, the IRS imposes a penalty of 25% on the amount he should have withdrawn. So Gary, who has spent 8 years carefully managing his income, who has structured his life to stay inside a comfortable tax bracket, suddenly has the government showing up at his door and saying, take this money, whether you want it or not, whether you need it or not, whether it is convenient or catastrophic for your tax situation or not, take it. With $1.4 million in his IRA at age 73, Gary's required minimum distribution, calculated using the IRS Uniform Lifetime Table, which at 73 has a distribution period of 26.5 years, comes out to approximately $52,800. He has to withdraw that amount. He has to pay ordinary income tax on every dollar of it. And that $52,800 gets stacked on top of his Social Security income, his pension, and anything else coming in that year. And that is when the silent partner pulls up a chair and orders the tasting menu. Here's something that people in their 40s and early 50s, the people who actually have enough time to change the outcome, tend not to appreciate. Required minimum distributions are not a static problem. They are a compounding math problem. Gary's IRA at 73 is $1.4 million. His first RMD is $52,800. But if the remaining account continues growing at 6% per year while he draws from it, the account could actually be larger at 77 than it was at 73, which means the RMDs get larger every year automatically. The silent partner's share of the exit keeps growing while Gary keeps aging. This is not hypothetical. This is the actuarial design of the distribution table. This is where it gets really interesting. Because the tax rate increase from the TCJ expiration is real and it matters. But it is actually the second most damaging thing happening to Gary right now. The worst thing has a name that sounds like a physics term. It's called the Tax Torpedo. And it hits Gary harder than the rate hike ever could on its own. Here's how Social Security taxation works. And I want you to stay with me here because this is the piece of the tax code that most working people genuinely do not understand until they're sitting across from a retirement planner at 64, and by then the window to plan around it is already smaller. A portion of your Social Security benefits becomes taxable based on what the IRS calls combined income. Combined income equals your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits. If that combined income number is above $34,000 for a single filer, up to 85% of your Social Security benefits are taxable. For married couples, the threshold is $44,000. These thresholds were set in 1983 and 1984. They have never been adjusted for inflation, not once, in over 40 years, which means that a couple with a perfectly ordinary retirement income in 2026, income levels that would have been considered genuinely modest in 2010, can easily find themselves above threshold. This was not an accident of drafting. This was a slow-motion bracket creep engineered into the legislation from the beginning. Every year, more retirees cross the line. Every year, the government collects more Social Security taxation on people who were never the intended targets. Gary is married. His wife, Linda, gets $14,000 a year in Social Security. Gary gets $29,000. Together, they're pulling in $43,000 in Social Security. Half of that is $21,500. Gary's pension is $18,000 a year. So before his first RMD arrives, his combined income is already $39,500, right below the $44,000 married threshold. At that level, 50% of their Social Security, about $21,500, is taxable. Then the RMD arrives, $52,800 added to that picture. Their combined income is now approximately $92,300. They are now dramatically above the $44,000 threshold. 85% of their Social Security, $36,550, is now taxable. Where before the RMD hit, they were paying tax on about $21,500 in Social Security income. After it, they're paying on $36,550. That is $15,000 in additional taxable income that the RMD didn't deliver. It triggered. The withdrawal didn't just tax itself. It reached into their Social Security and pulled that into the taxable pile too. That is the torpedo. It doesn't land on a flat surface. It lands on a surface loaded with combustibles. And the explosion is bigger than the bomb. The IRS loves Gary right now, and Gary has no idea. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. You think the problem is that tax rates went up in 2026. But actually, the problem is that Gary's RMD triggers a cascade, a bracket pushed higher, more Social Security pulled into taxable territory. And there's one final layer I haven't touched yet, which is the one that genuinely makes financial advisors slightly pale when they walk through it with clients who are approaching retirement without a plan. This layer costs money every single month, and it comes in the form of a bill from Medicare. Before that, though, let me introduce you to a couple from Ohio, because Gary's situation is not unusual, and I want you to see how this compounds when you add one more common mistake on top of everything else. A couple, the husband, a former sales director, with a wife, a retired school administrator, retired in 2019 with $1.1 million in a traditional IRA and another $400,000 in a taxable brokerage account. Their financial advisor ran the numbers in 2019 and told them, based on your projected withdrawals and Social Security income, you're looking at a marginal rate of about 22% in retirement. You're in good shape. They felt good about this. They went to Italy. They bought a boat, a small one, but still a boat. Then 2026 arrived. Their advisor called them in January. Same projected income numbers, same lifestyle. Now they're in the 25% bracket because the TCJA expired. And then she said also, about that rental property you've been thinking of selling. Medicare has a surcharge system called IRMA, the Income-Related Monthly Adjustment Amount. If your modified adjusted gross income in a given year is above certain thresholds, you pay more for Medicare Part B and Part D automatically every month, no appeal unless you can prove a qualifying life event. In 2025, a single filer with income above $106,000 is already paying an additional $70.90 per month on Part B. For married couples, the threshold is $212,000. Beyond that first tier, the surcharges step up sharply. Here's a detail that nobody explains until it's too late. Medicare uses your income from 2 years prior to set your current premiums. Your 2026 Medicare premiums are calculated based on your 2024 tax return. Your 2027 premiums are based on 2025. So the year you start taking RMDs, and remember that RMD can push your income well over the RMAA threshold, the Medicare surcharge doesn't arrive the next month. It arrives 2 years later when you've already spent the RMD. When you've completely forgotten the connection, you get a Medicare premium notice that seems to have materialized from nowhere, and you're furious, and there is genuinely nothing you can do about it at that point. Gary's combined income in his first RMD year, roughly $92,000, puts him and Linda into IRMA territory. 2 years later, their combined Medicare Part B surcharge is approximately $253 per month above standard. That is over $3,000 a year for Medicare, on top of the income tax, on top of the Social Security taxation cascade. Because they had too much income the government forced on them through mandatory withdrawal rules. The Ohio couple sold their rental property in 2026, same year their RMDs started, same year the TCJA expired. Their income that year was so elevated they hit the second IRMA surcharge tier, not the first. They ended up paying an additional $594 per month on Medicare Part B per month. For the following year, that is over $7,100 in Medicare surcharges alone in a single year, on top of the capital gains tax, on top of the RMD tax, on top of the higher bracket from the rate changes, 5 separate forces hitting simultaneously because nobody mapped out the calendar. The boat, incidentally, was sold the following spring. The silent partner is thorough. He shows up everywhere. Now, about what you can actually do. Because I don't believe in spending 15 minutes explaining a problem without spending at least as much time on the solution architecture. And the architecture here is more accessible than most people think. I'm going to call it the 3 exits from the silent partner's grip. These aren't exotic strategies. They don't require offshore accounts or complicated trust structures. They're legally available to any American with a retirement account, and they are systematically underused because most people don't learn about them until the window has already narrowed. The first exit is Roth conversions during the gap years. And this is the one I want to emphasize most because the leverage here is the highest and the window is the most time limited. Most people think of Roth conversions as something you do before you're making real money, early career stuff. That intuition is completely backwards. The single highest leverage moment to do a Roth conversion is after you retire, but before your required minimum distributions start. Let's say you retire at 62 or 63. You're not taking Social Security yet. No RMDs. Maybe you have a small pension or you're drawing from a taxable account. Your income is temporarily lower than it's ever been as an adult. This is the window. Every dollar you convert from a traditional IRA to a Roth IRA during this period gets taxed at your current temporarily favorable marginal rate. And from that point forward, those dollars grow tax-free, come out tax-free, and critically are not counted in the future RMD calculation. You are shrinking the account that the silent partner has a claim on. You're paying him now at a rate you can partially control rather than later at a rate he sets. Gary didn't do this. Gary retired at 65 and spent the following 2 years doing nothing with his IRA, watching the market go up, which felt good. But those 2 years were the lowest income years he'd experienced since his 20s. He was in the 12% bracket in 2025 before it expired. He could have converted $100,000 a year from his IRA to a Roth paid tax on it at 12% and meaningfully reduced his future RMD obligation. He didn't know. His advisor, to be fair, brought it up once and Gary said he'd think about it, and then he went to a barbecue and forgot. This is a repeatable, avoidable, devastatingly expensive mistake. And it happens to smart, capable, financially literate people all the time. Even if you're already taking RMDs, partial conversions may still make sense in years when your income is relatively lower after a market dip, for instance. When converting the same number of shares costs you less in tax because the value is temporarily lower. The math changes every year, but the principle doesn't. The second exit is qualified charitable distributions. And if you give to charity and you are 70 and a half or older, this is arguably the most underused provision in the entire individual tax code. A QCD allows you to donate up to $105,000 per year as of 2024 directly from your IRA to a qualified charity. And here's the mechanics of why this is extraordinary. That charitable transfer counts as your required minimum distribution. It satisfies the IRS mandate, but it never hits your adjusted gross income. The money goes directly from your IRA custodian to the charity. It appears on your tax return as a distribution, but is excluded from income, which means it cannot trigger the Social Security taxation threshold. It cannot push you over the IRMA cliff. It cannot inflate your AGI in any way that costs you money somewhere else. The silent partner shows up at the restaurant. The bill has already been paid. He gets nothing. He sits down, picks up the menu, and the waiter tells him the kitchen is closed. Gary and Linda give around $22,000 a year to their church, a local food bank, and a scholarship fund at Linda's alma mater. They write checks from their joint checking account every year, post-tax money. They get a charitable deduction, which is less valuable after the TCJA expiration reduced the standard deduction, but they still itemize, and that's the end of it. If instead they directed those $22,000 as a qualified charitable distribution from Gary's IRA, three things happen at once. Their taxable RMD drops by $22,000, their combined income falls below the IRMA threshold, and the percentage of their Social Security that is taxable decreases. Three separate wins from one administrative change. But they weren't doing it. Nobody told them. It doesn't come up in the average advisor meeting unless you specifically ask. The third exit is income smoothing, which sounds boring. It is boring. It is also where tens of thousands of dollars live. Income smoothing means building a multi-year income projection, a calendar, essentially of every significant taxable event across the next 10 to 15 years. What year are you selling an asset? What year do you start Social Security? And remember, you can delay it up to age 70 for an 8% annual increase in your benefit, which may or may not be worth it depending on your health and income needs. What year do your RMDs start? Where are the income spikes? Because the spikes are the enemy. They push you into higher brackets, trigger Social Security taxation, and set IRMA surcharges that you'll pay 2 years into the future. If you can see them in advance, you can reorganize the timing of your capital events around them. You can sell the rental property in a low-income year, not the year everything else is happening simultaneously. I know someone who, and this is almost too perfect, scheduled 3 major financial events in the same calendar year because he didn't realize they were financially connected. He took his first RMD. He sold a vacation property his family had owned since the 90s, and he received a large insurance settlement from a claim filed 2 years earlier, all in the same tax year. His accountant called him in February of the following year and said, "I have some news." He said, "Good news?" She said, "I have news." He ended up paying more in federal income tax that year than he'd paid in the previous 4 years combined. Not because anything went wrong, because nobody mapped the calendar. Income smoothing doesn't require a financial advisor with a fancy office. It requires a spreadsheet, a tax calculator, and the willingness to think 4 years ahead instead of 1. That's it. The math is not complicated. The discipline to actually do it before things happen instead of after is harder than the math. Now I want to come back to Gary, because I left him in a bad spot several minutes ago, and I owe him a resolution. Late 2025. Gary's financial advisor finally ran a full RMD projection at his annual review, which was the first time she'd done this in the 3 years since Gary retired. She printed it out and put it on the table between them. Gary looked at it for a long time. He's an engineer by training, 30 years optimizing production lines. He has a brain that is physically uncomfortable with inefficiency. He said, "That's a terrible system." She said, "Yes." He said, "Who designed this?" She said, "Nobody specifically. It accumulated over decades of legislation from multiple administrations." He said, "Can I fix it?" She said, "Partially." And partially is significantly better than nothing. So Gary, at 67, started doing targeted Roth conversions. He didn't do massive ones all at once that would push him into a higher bracket during the conversion years. Instead, he identified his projected total income each year and calculated exactly how much he could convert without crossing into the next bracket. In 2025, he converted $68,000 from his traditional IRA to his Roth. He paid tax on it at the 12% rate before the TCJA expired. In 2026, he converted another $55,000 at the new 15% rate, less favorable, but still below what he'd face during mandatory RMD years. He also opened a donor-advised fund with $25,000, which allowed him to preload several years of charitable giving, take the deduction in a single year, and then direct grants from the fund to his preferred charities over time. And he scheduled the sale of his one remaining rental property for 2028, 2 full years before his RMDs start. So the capital gain lands in a year where it's the only major income event, rather than another log on an already burning pile. Gary's advisor told him something at the end of that meeting that I want to repeat because it is the best single sentence description of retirement tax planning I have ever heard. She said, "The goal isn't to avoid taxes. The goal is to choose the taxes you pay in the years you pay them at rates you still control. Taxes you choose versus taxes that happen to you. That is the entire game." There's something psychologically important underneath all of this that I don't want to skip past, because this channel cares as much about the psychology of money as the mechanics of it. Most people, when they think about their retirement account balance, think, that number is mine. And in one sense, it is. But what they actually have is a gross number, a pre-tax number, with a government claim embedded inside it at an undetermined future rate. The number on your 401k statement includes the government's portion. You don't know what percentage that is yet, because it depends on tax law at the moment of withdrawal, which you cannot control. You are not locking in your tax rate when you save. You are deferring the determination of your tax rate to a future moment set by legislative processes you have no vote in. This is not a conspiracy. The deferral is genuinely mathematically valuable. You get 30 years of compounding on money you would have surrendered to the government earlier. It works. The strategy functions as designed. But the psychological framing, "my retirement savings grow tax-free," causes people to massively underestimate what the tax bill actually looks like on the back end. They plan based on the number on the screen instead of the after-tax number they'll actually be able to spend. They retire with $1.4 million and feel wealthy and secure. And technically they are, but if they're in the 25% bracket during their RMD years, drawing $60,000 annually, $15,000 of that 60 goes to the federal government every year for 15 to 20 years. That's somewhere between $225,000 and $300,000 paid to the IRS over the course of retirement on money they already earned, money they saved carefully for decades, money they assumed was theirs. The silent partner share, delivered in installments with interest. One more thing about the 2026 rate environment specifically, because I know there's a version of you watching this that's thinking Congress will fix it. They'll extend the TCJA provisions or pass something new. And look, maybe there have been proposals. There have been counter proposals. Partial extensions have been floated in both chambers. But here's the honest analytical reality. The history of Congress acting decisively on tax policy in politically contentious years is not a history that rewards optimism. And even if something does get done, it will likely not be retroactive, meaning the year one impact hits regardless. The prudent planning assumption is that you act as if the higher rates are real until a law is actually signed, not proposed, signed. Because the downside of acting on the assumption that rates are elevated and being slightly wrong, you converted a bit more than you needed to, you paid a slightly higher rate than you had to, is modest. The downside of assuming everything will get fixed, being wrong and receiving the full force of rate increases, plus RMD cascades, plus Social Security taxation, plus ARMA surcharges all in the same year is devastating. Asymmetric risk. One side is annoying. The other side is irreversible. Planning for the worst plausible scenario is not pessimism, it's math. I've spent over a decade running a business, sitting across tables from accountants and tax attorneys whose job was to show me how money actually moves. And the thing that surprised me most, genuinely, more than anything else, was how much of the real financial game is timing. Not stock picking, not asset allocation, not which mutual fund has the lowest expense ratio, although that matters too. Timing, deciding which year to recognize which income, which year to convert, which year to sell the property, which year to start Social Security. The compounding math is straightforward. The tax timing layer is where the real money lives and where most people never look. 3 practical takeaways specific to this situation, not the generic retirement advice you've already heard. First, if you are in the gap between retirement and your RMD start age right now, or if you retire in the next few years, Roth conversions during that window are the highest leverage move available to you. Your income is temporarily lower than it has ever been as an adult. The tax rates you pay on conversions now, even at the post-TCJA levels, are likely lower than what you will face when mandatory distributions are stacked on top of Social Security and pensions. Convert systematically. Don't try to convert everything at once and push yourself into the top bracket. Work the brackets. Fill them up each year without crossing into the next one. Do this with a fee-only financial planner who charges a flat fee and has no incentive to sell you product. Second, if you are 70 or older, if you give to charity and you are not doing qualified charitable distributions, you are donating with after-tax money when you could be donating with pre-tax money that also satisfies your RMD and eliminates the income cascade entirely. This is not a trick. It is a provision in the tax code that Congress specifically designed to help retirees in exactly this situation, and it is used by a small fraction of the people who qualify for it. Up to $105,000 per year directly from your IRA never touches your AGI. This is your move. Third, build the income map. Not a retirement savings calculator, an income calendar. Year by year, event by event for the next 15 years. When are you taking Social Security? When do RMDs start? When are you selling assets? Where do the income spikes occur? And then ruthlessly, deliberately separate those spikes so they don't land in the same year. The Ohio couple with the boat and the rental property and the insurance settlement didn't have a math problem. They had a sequencing problem. The math was fine. The calendar was a disaster. The silent partner always collects. That's not a question. The only question is whether you chose the timing and the rate or whether it happened to you on someone else's schedule. Lazy investing built more fortune than crypto memes. Gary's advisor called him 3 months ago to run his updated projections. She told him his cumulative tax liability over the next decade is now approximately $42,000 less than it would have been without the changes he started making in late 2025. He thought about it for a second and said, "That's basically a car." She said, "A nice one." He said, "I should have done this 5 years ago." She didn't disagree. The IRS isn't coming for your retirement account because it hates you. It's coming because the appointment was always on the calendar, and the only thing that's changed is that the date is no longer in the future.